Sending money from Canada to India can be a complex process, and understanding the tax implications is crucial to avoid any penalties or fines. In this guide, we will walk you through the step-by-step process of calculating the tax you need to pay when sending money from Canada to India. First, it is essential to understand that there are two types of taxes you need to consider: Canadian tax and Indian tax. In Canada, the tax is deducted at the source, and the sender is required to pay a withholding tax on the amount being sent. The withholding tax rate in Canada is 25% for non-residents, but this rate can be reduced to 10% if the recipient is a resident of a country with which Canada has a tax treaty, such as India. To calculate the Canadian withholding tax, you need to determine the amount you want to send and multiply it by the applicable tax rate. For example, if you want to send 1,000 Canadian dollars to India, and the applicable tax rate is 10%, the withholding tax would be 100 Canadian dollars. In addition to the Canadian tax, you also need to consider the Indian tax implications. In India, the recipient is required to pay tax on the amount received, and the tax rate depends on the recipient's income tax slab. If the recipient is an individual, the tax rate can range from 10% to 30%, depending on the income tax slab. To avoid double taxation, Canada and India have a tax treaty that allows for a foreign tax credit. This means that the recipient can claim a credit for the tax paid in Canada, which can be used to offset the Indian tax liability. To send money from Canada to India, you can use various channels such as banks, money transfer operators, or online remittance services. Each channel has its own fees and charges, and you need to factor these costs into your calculation. On average, the fees can range from 1% to 3% of the amount being sent. In conclusion, calculating the tax you need to pay when sending money from Canada to India requires considering both Canadian and Indian tax implications. By understanding the tax rates, tax treaties, and fees associated with each channel, you can make informed decisions and avoid any penalties or fines. It is always best to consult with a tax professional or financial advisor to ensure you are meeting all the tax requirements and taking advantage of the available tax credits.